Good morning, everyone. Welcome to the Macro Snapshot. It's Friday the 13th in June at about 7:40 in the morning, 2025, of course. Okay, so the main news overnight is that the Israelis did, in fact, launch some attacks on sort of the Iranian nuclear facilities and sort of infrastructure. From what I'm gathering, just reading this morning, it seems that it's potentially it's not the end. A lot of the Israeli senior commanding officers have been sort of tweeting and sort of communicating that this is the beginning of a series of attacks. It could escalate, it could be incrementally sort of increased. And it seems to be that the goal of the Israelis here is really to deal maybe even a fatal, definitely a significant, but possibly even a fatal sort of knockout punch to the whole sort of Iran sort of nuclear sort of infrastructure. Now, what's interesting just in terms of markets, well, obviously geopolitically, that's going to add some instability to the Middle East. Let's hope it doesn't escalate into sort of a wider regional conflict now between Iran and Israel. And we all know what's been going on for the last year. So in general, especially for the oil complex, this does add a lot of volatility. And if we actually look at the oil just reaction here, I've got a few sort of different charts and whatnot. We can see that if we look, this is where we are now. This is the white line. So this is each month represents a forward contract. So as you can see, and this blue line here represents yesterday. So what you can see is that the outright price has jumped quite significantly. We're now trading at about where are we? We're about $73 on the front contract of WTI. And yesterday we were trading at 68. So about a $5 sort of rise there. And of course, one thing to understand about that, although it's a little bit marginal, but definitely that could add upward pressure in terms of inflation, which in theory the Fed will not like once that starts feeding in, assuming these prices remain elevated. And also the long end of the bond curve will not like that because that's got to be inflationary pressures. So in general, at the margin, this potentially could also sort of put a bit of upside pressure on inflation. But as you can see here, the shape of the curve still very much in sort of a pretty strong backwardation. The other thing to be looking at here, just kind of curious, is just always actually I'll put this is this the spreads here? No, that's the VIX there. So if we look here, this is the call put sort of ratio here, and you can see here this is a 60-minute chart, and I think I was talking about this yesterday, and you can see the price of the call premium here in the white, and in the put premium here in the orange. Now, normally this is negative because puts, there's a bit of a premium for puts. As you see going back, it's normally negative. But you can see here that on the 60-minute chart, the premium paid for calls obviously sort of spiked pretty high, and you can see here that the premium the skew is at its highest. It's been for a long time actually, just looking at it. So you see that's very much a premium there for calls. And the other thing which I just want to show is I think I had the spread here. Yeah, I put the spread here of CL1, CL2. So this is the prompt contract or the front contract versus the second contract. And again, on a 30-minute chart, you can see here just over the last 5 or 6 days, it had been just sort of grinding upwards. There had been some rumblings about a potential Israeli attack, but you can see here that this really spiked. The attack happened, I think, about 11 p.m. last night, 10:30, 11 p.m. last night. And you can see here that it spiked up. It's subsequently come off a little bit. You see the outright price has also sort of faded a little bit, but definitely the curve there, that's causing a bit more backwardation at the front of the curve as the market tightens a little bit. Now, what's kind of interesting is that, as I say, this was not an attack on Israeli oil facilities or sort of gas infrastructure. It was really, from what I'm sort of reading sort of this morning, it didn't really directly attack any of that. And it was much more on the nuclear facilities. Now, that's not to say that, if a war started, that of course the Israelis would probably escalate and then start attacking the sort of oil and energy infrastructure and production facilities and refineries and whatnot. And that would cause a very significant sort of spike. And what you can see here on this daily chart, you can see that it's spiked up, but you can see that we've given back quite a lot. And if we put that down, let's put this on a 30-minute chart. Actually, let's put on a 15-minute chart just for a little bit more granularity, as people like to say. So you can see here that when the news of the attack sort of came in, which is basically sort of last night, you can see that it spiked up. And then basically by about sort of 11 o'clock, the prices come down a little bit. And I think that was just on news that this was really an attack on the nuclear facilities and not the oil and refining sort of infrastructure. And keep in mind that where Iran is a fairly significant producer of oil, and we know that the Iranian oil, it comes down sort of around through the Straits of Hormuz, which is extremely tight. It's only about, I think, 20 or 30 kilometers, and about 20 million barrels a day of oil come there, if my memory serves me correct. So if this does escalate, the point I'm trying to make is that we had this initial spike of, $4 or $5, but if it does escalate into something more serious and the Israelis start attacking the oil and gas infrastructure and refineries, and probably even more importantly, the rest of those oil producing nations, which need to get their oil to market through the Strait of Hormuz, that we could easily see oil, I think, going up a lot more, let's say into $80 or even up to 85 or 90. That can definitely spike another $5, $10, $15. So that's definitely something to be looking at. So that's obviously oil sort of spiking on that. What is interesting is just to look at the reactions. So I'm just going to put it, let's put it, I don't know, maybe on a 30-minute chart. And it was a pretty classical sort of risk off sort of reaction. So what we've seen, let's just go through some of the reactions here. We saw that obviously the VIX spiked, and I'll just show you the VIX here. I have this, I do believe I have this here. Yeah, so if you look at the VIX, this is the VIX where we're trading at the moment. We're trading the front spot is at about 20.3, and then you can see. But what's interesting here is that the first contract is actually below. So that's a little bit of sort of pressure on the VIX curve. And if you compare it to a day ago, you can see that that's gone up quite a bit. So look at the shape of the curve and the outright. So you see the outright spot price was down at about 18, and you see obviously that's jumped up to about 20.4. So it's gone up 2.5 points there. But also just look at the shape of the curve here. You can see the front there is flipped a little bit. So it's definitely not where it was. Let's say if we go back, I don't know, a couple of months ago, we can go back just to put this into context, put it on, let's say after Trump's sort of adventures in sort of liberation. Let's say after liberation, we'll go something like the 4th of April. So that's just the context of where we were. So you see the VIX at that point up in the 30s and 40s, and you see the shape of the curve was in a backwardated state. So, all things considered, this is relatively modest, but it does represent, sort of a higher, um, oops, let's just close that. A higher sort of volatility. So getting back to some of the charts and the reaction, as I say, a fairly classic risk off reaction. What is interesting is that the ES, as you can see on the news at about 7:30, the peak of the attacks getting, as I said, about 10:30. So you see the VIX, so the ES, so the US futures down, but subsequently they've recovered. And generally, what happens in this unless this sort of escalates, I don't think this is going to have sort of a long-term effect in terms of the equities. But if we can look out and look at some of the other markets, we can see that what is interesting for me is that the bond market, let's look at the 10-year, it did spike up a little bit, but subsequently sort of gave it back. So the bond market sort of really underplaying it and not having too much of a reaction at all. Where we did see the reaction, of course, was in oil, which we just looked at. You can see that oil spiked up a lot, but even oil's given back about 50% of that initial spike. In the currencies, we see that the dollar, interesting for me was that the dollar did act as a safe haven and continues to remain relatively bid. Now, if we actually go on a daily chart, we can see that the dollar index here, which is very, very oversold. You can see that I just wonder if this is quite an interesting reaction to me, because you can see here that the dollar bounced off this pretty key level of 97.9 more or less, and acting as a safe haven. So I was a bit surprised that it acted more of a as much as a safe haven compared to some of the other currencies. And I just wonder here, you see this sort of double bottom, whether this was a little bit of a technical bounce as well for a very oversold dollar reacting off sort of a pretty strong horizontal support. But nonetheless, the dollar remains quite bid this morning. And if we look at some of the other sort of currencies, what was interesting for me was just looking at the Japanese yen, because we see the Japanese yen against the dollar didn't actually appreciate much at all. In fact, as we see the dollar sort of bounce. But again, it was just interesting, sort of coinciding with a sort of a technical level. We did see the euro go down quite a lot here versus the dollar. And what really did act as a safe haven was the Swiss franc, which acted as a safe haven. But again, the US dollar acting, coming back very, very quickly and strongly. So interesting that the US dollar reacting, really as a safe haven, even more than the Swiss franc or the or the Japanese yen here. And but as I say, I wonder if that's indicative of sort of some wider issue, or it's also just going off that sort of bouncing off that sort of technical level here. What I will look at though is just to have a quick look at some of these cross pairs, and you can see here the euro Japanese yen sort of fell initially on the move, but again the euro sort of clawed back a little bit. And if I look here at the euro Swiss. You can see the euro Swiss, the euro fell versus the Swiss franc, but that's sort of given back as well. So my takeaways, just in terms of some of the currencies here, is that definitely the dollar, it is bouncing off that technical support. The Swiss franc does seem to be acting more as a safe haven than the Japanese yen. Japanese yen is finding it hard to maintain too much strength, and the euro, despite everything, is still relatively bid. So it's interesting to me. I think the winners out of this is probably the euro in a certain sense. That's what I'm looking at. What also is very interesting for me was looking at gold and Bitcoin. So if you look at the reaction of gold, you can see here that gold, it has been on an uptrend, as we know, very, very strong. But you can see here at 7:30 when the news came in, gold sort of ripped higher. It's given back, but this to me is looking a bit like a sort of a bull flag, which could be headed higher for a continuation pattern here. We'll see that again. But interesting, if you look at silver. And you see that silver didn't have nearly the same reaction here, which is, sort of normal. And so silver underperforming. And then if we look at the other metals, let's say copper, also underperforming significantly there. So definitely copper, everything acting fairly classically there. Sort of gold up, silver not quite sure what to do, and copper falling. What was interesting to me is also the reaction of Bitcoin. If you look at Bitcoin, let's have a look at BTC. So we see that Bitcoin here sort of fell quite dramatically. It almost looks more like a copper chart. It's come back a little bit, in the overnight session. But it's interesting to note here that gold, definitely in terms of a safe haven, definitely completely outperforming BTC. Just something to put in the back of the mind and understand for the future. Okay, so let's just put everything back on sort of a daily charts here and see where we're at. Again, we see that the VIX is up a little bit, but already giving it back, so probably going to head back down to sort of 19 or 18 or something like that. The ES, fell initially on the news. But basically still looks very strong. You have to say at this point, there's no particular sort of technical damage done. And at this point, you see all the moving averages, the 20, 50, 100, and 200, the EMAs, they're all still sort of gently sort of moving upwards. You have to say that, all Fibonacci retracements have been bought. We're making sort of higher highs and higher lows. The only thing here is we're definitely coming into sort of upside resistance at this point. So we're going to have to see what happens. Now, yesterday we did get a little bit of data. So let me just put on some of that. So we had the PPI. You remember that we had the CPI, which was lower than expected, and the market was looking yesterday to see whether that would be sort of confirmed by the PPI. Excuse me, a little bit of Earl Grey this morning. And you can see here that the PPI, here's the sort of month over month, the headline number, that came in lower than expected. And we can also see that the core number came in quite a lot lower than expected. So that was kind of a positive for the front end of the curve, basically sort of supporting this idea that maybe inflation is attenuating a little bit, softly, sort of softening, so to speak. And secondly, that the tariff impact either will not be as bad as feared, or, as I was saying yesterday, that it simply hasn't had time to sort of filter its way into new inventories. And keep in mind that a lot of the goods being sold at the moment are still from old inventories, and sort of inventories which essentially front run the tariffs. And so there's still plenty of opportunity for the new batch of inventories and new imports to reflect higher tariff prices, which of course is always going to be a little bit in flux. But what we can also see here is that we had the initial jobless claims as well, and the market was kind of interesting just to see. Just by the way, look at these sort of net interest expenses. You see here 2025 in the US higher than it's been ever basically, and just the US now is pretty crazy, spending fiscal year to date over $600 billion just on interest payments. But what also was interesting yesterday is the weekly initial jobless claims, and it does seem as though it's still not in any kind of recessionary levels, but definitely sort of it looks to be softening a little bit. You can see for 2025 seasonally adjusted, you can see here we are in about week 23 to week 24, that we're, starting to push above some of those recent years and definitely getting a little bit higher, and even non-seasonally adjusted, looking a bit higher. And if we look at continuing claims, 2025 in this deep blue, you can see that we're, definitely seems to be pushing a bit higher than the last 3 or 4 years, excluding COVID, of course, 2020. So the takeaway there is probably that the labor market, whilst it's still relatively robust, does seem to be sort of weakening slowly. We have a little bit more information this morning. We have the University of Michigan. We have the preliminary sort of survey numbers for June. Again, this number, which used to be of some interest, and again, it is definitely for interest, in terms of the 1 year inflation expectations and the 5 to 10 year sentiment and current conditions, whatnot. We'll see how it all goes. But this has been very polarized from a political point of view. And it seems that over the last sort of, I don't know, 6 to 12 months, respondents now, they're being very pessimistic if they're Democrats. They're being very or much more optimistic if they're Republicans. And the second thing is that the methodology, before it used to be phone calls, as far as I understand, and they've switched just to an online filling in a form. And definitely, it seems that the outliers are a little bit more sort of prevalent. So what do I mean by that? I mean that the methodology has changed. And so whereas before, if someone said, if the interviewer would say, what is your expectation for inflation this year? And you said, 15%. Maybe the interviewer would gently push back and say, are you really sure that 15% is a credible number? Whereas now, people are just putting in much more extreme levels. So it's possible that the methodology changes to a completely online response is skewing this a little bit. All that to say, long story short, is that I'm not sure how much attention the market will pay for this. And from what I'm understanding, the market is paying less and less attention to that. So we do have the Fed coming up on the 18th, which is next week. So it's going to be important of June. And if we actually look where we are, as you can see, we're back to over sort of 2 cuts, so about 51 basis points of cuts. And you can see here just on the intraday tick chart that this is just a function really now of a little bit of geopolitics, but not particularly, this kind of stuff is not really affected by what's going on in Iran and Israel, except at the periphery as it relates to inflation and energy prices. And just to recap here, we saw that when we had the sort of the job numbers, the non-farm payrolls, basically a week ago, you can see here that sort of pushed everything to be repriced very hawkishly. And then, subsequent to that, we've got the CPI numbers, then we had the PPI numbers, which has brought it back down. And we went even above 2 cuts to 58 basis points. Now, overnight, that's just sort of gone up a little bit. And I wonder, again, it's just with the spike in oil prices, is that sort of feeding into this narrative that higher energy prices could mean higher inflation, which means the Fed will have less possibility, or it won't be as easy for the Fed to cut. So I think that's what that is, that we've gone from about 57 basis points overnight to about 50 basis points as we speak here in the morning, about 5 or 6 basis points of sort of tightening. But basically, we're at 2 cuts. All will be revealed next week when we get the update to the dot plots and see if the Fed continues with the 2 cuts. I think I'll leave it there, guys. So as I say, there is still definitely geopolitical risk. The headlines continue to come in. We just had Trump talking. So the thing is, I don't know if the equity market is going to be able to rally over the weekend, because there's definitely some geopolitical risk over the weekend. But historically, in this kind of situation, specifically if the oil and gas facilities are not being directly targeted, I think that there's no particular reason for the equity market to have a big sell-off until and unless, as I say, we get a much bigger escalation in direct conflict between Iran and Israel. And secondly, if the oil facilities specifically are targeted, but we don't seem to have that yet. And just notice as well that the bond market is really just seeing this as an inflationary sort of factor rather than sort of a serious threat to, let's call it, developed world markets. Okay, I'll leave it there. Have a great week and weekend, and let's keep the conversation going. Thank you.